Welcome everyone. Thank you for joining us for today's webinar. My name is Shrikant Akolkar and I'm Senior Analyst at Angel Broking. Today I would like to talk about stock market simplified for you. Before we get started, I would like to go over a few items so you can know how to participate in today's webinar. You can type your questions into the questions pane of the control panel. You may send your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's presentation. This is a webinar structure, how we are going to talk about this topic. So first we'll see what is stock market. Then we'll move over to the impact of macro events on the market. Then to the secrets to generate wealth in stock market. So here we'll talk about what kind of simple strategies people use in stock market. Then we'll see what is bull and bear market, and finally we'll see key terminologies that will help you understand when you are dealing with analysts or brokers, or in general when you have any attention to the media or television when they're speaking. So these terminologies will help you. The first thing is, what is stock market? Now, stock market is a marketplace where investor buy shares of public companies. So it's basically like in today's terms, it is like a Flipkart or Amazon where you buy products. So here the companies like Samsung which are selling their products. So these are like public the sellers, and when we buy the items we are like a buyer. So in stock market similar thing happens. There are people who wants to sell their holdings and there are some people who want to buy their holdings. So stock market is a marketplace which provides a platform for people to buy or sell securities. Now it is governed by the Security and Exchange Board of India laws. So which means there are government restrictions on selling different type of securities or how they are sold. Even for the brokers, sub brokers, and analysts, there are a lot of regulations which have to be followed by every participant. And this all the laws that also help to bring down any speculation or any type of frauds that happen in market. Earlier we remember there were major frauds happened, but with laws becoming very tight, there are less chances of becoming anything of that sort in future. uh, Now, the first thing that comes in your mind when you are thinking of stock market is how share prices are determined. Now, let me tell you that it is a very simple process and which is governed by simple law of demand and supply. So there are buyers and there are sellers. So what happens is buyers will want to buy particular share, and sellers, if there are more sellers, the price will go down because there are more sellers. And if there are more buyers, price will go up because there are few shares to be sold in the market, but there are more buyers. And how, as in the question is, what is the kind of interest in the share price, or how exactly different companies are trading at different prices. Now here is a common item that we see every day on the popular website. Now we have I have just pulled four different smartphones. All of these are 4 gigabyte memory and around 32 GB uh, memory, 4 GB RAM, and 5.5-inch display. All smartphones, but you can see the prices how they are different. So Lenovo is around 10,500, and the max range is Sony Xperia, which is 25,000. Without going more in nitty gritty, what we see is all the companies having almost same configuration are offering different prices. What we see here is the perception of the brand. Sony is perceived to be a big brand, so they are offering 25,000. And why they are offering mobile at higher prices? Because they are also giving some value additions in the phone, whereas basic structure of the phone remains the same. Similarly, Apple is giving price of around 19,000 because they are offering something which is better than Lenovo, but which is less than Sony Xperia. Also, the brand value is mattering a lot here. Same thing happens in the stock market. there are buyers and there are sellers. So when a person wants to buy, he will have his own opinion, and when there is a seller, he also have his own opinion. Now I'm showing this screenshot of Looping Limited, and you can see that how different people have different opinion. So the first screenshot is one of the broker report, and their target is 940, and they are saying it is what, which means do not sell or do not buy any fresh shares, keep holding the stock. Whereas the next screenshot says that the stock price should be 875, or the third screenshot shows the price should be 860, and the last screenshot shows extremely bearish price of 760 and 12% downside. So what happens is, any investor who has buy opinion buy, so they will go ahead and buy the stock. So the third screenshot with 860.5 target, investors with these kind of price target will go ahead and buy. Whereas the last screenshot where there is clearly written sell means these investors are generally bearish on the stock. So all these different type of investors make the market, and the collective force of their buy and sell will decide the stock price. Now here is how they are decided in general by analyst and investor. Stocks are bought based on the perception of the value of underlying business by the investors. The value of the business is determined based on economic cycle, industry cycle, analysis of the end markets, government policies, products, industry, and competition. And I'm also giving an example. For example, Maruti, which is a very popular company. Now, if that stock is trading at 9,500 rupees, which means that collectively market believes that the value of the Maruti share should be now 9,500. But there will be few people who believe that the shares are worth 10,000 rupees, so they will go ahead and buy the shares. But all of those who are believing that it should be less than 9,500, they will be going ahead and selling the shares. So if buying pressure is more, as in there are more buyers, the stock price will rise. If there are more sellers, stock price will collapse, and that is a simple fundamental how the prices are determined. In the long run, the first paragraph which I mentioned about cycles of different sort, product competition and valuation, all of these will matter. Now, anyone who is new entrant in the stock market will obviously will be very skeptical, because stock market is generally regarded as somewhat a risky investment, because of several factors impacting the stock market: sentiment, global geopolitical, oil prices, currency movement, etc. But in the long run, if you see fixed deposit, so these are now, before I go ahead and tell you, this is a 20-year return chart, which is after tax and transaction cost. So if we look at 20 years fixed deposit, which is a traditional instrument where most of the Indians park their money, has delivered 5.3% return on an average every year. Gold, which is also one of the traditional asset, is 7.4% return over last 20 years. Real estate 9.4%, and equities are standing tall with almost 16% returns. Now this is a kind of power of equity, and why this happens is because equity is, there are two types of benefit that we get when we invest in equities. One is regular dividend payment if you are investing in stable companies, and second is the growth of business, which leads to superior profitability of a company, which helps you in capital appreciation in the shares of that company. So equity is standing tall because of these two reasons. And the third one, which is applicable to every other asset class, is compounding. And in case of equity, compounding works far better because returns are hefty. So compounding is also better than other asset classes. Now, when we say that we want to buy a stock, obviously people are generally looking at stocks which are at lower price. So for an example, any share that is worth 10,000 and other share price which is around 100 rupees, people tend to buy the one which is at 100 rupees, without knowing that that is now how stocks are valued. The stock valuation is the most important aspect of investing, and this is also a very complex process. So I want to simplify this process by telling you what is valuation in terms of real estate valuation. Now here is a scenario. You have two houses. One the house first is available at 1.75 crore rupees, and second house is available at 1 crore rupees. If that is the piece of information you have, then you will obviously say that I will buy second house. But if I give you more information that house 1 is 1500 square feet and house 2 is 1100 square feet, you will obviously go ahead and calculate what is per square foot price, which is around 11,667 for house 1 and 9,091 rupees for second house. Now this is where you will find that first house is still expensive, but if you go more, dig deeper, what you get is house 1 is 1 year old property, house 2 is a 10-year old property. House 1 is in the city, whereas house 2 is outskirts of the city. And house 1 will have less maintenance expense because it is a very new property, and house 2 will have regular maintenance. So you will obviously say that I will buy first house. So in that case, the kind of premium around 9,000 to around from 9,000 to around 11,600 rupees premium. So that premium is justified on house one. And in general, people will tend to buy this property even though it is a little expensive. The same thing happens in a stock market. You don't look at the stocks based on their price. The valuation methods are different. So here is one example where we are valuing two different companies. Now we know these companies. One is MRF, second is CAT. Both of them are fairly known by the investors and the retail guys. And MRF is quoting around 73,000 on the stock market. So the one share is priced at 73,000 rupees. CIT is valued at 1,948 rupees. These are yesterday's prices. So market cap works to be around 31,000 crore for MRF, and for CIT it is 7,905 rupees, 5 crore rupees. But if you look at the price to earning ratio, which is a valuation parameter, the P of MRF works out to be less expensive compared to CAT, which is 13.5 and MRF at 13.2. So here you can see that even though the stock price in absolute term is very expensive at 73,000 rupees, price to earning ratio is 13.2. Now, what does this tell you? That we should not look at the stock prices on the face value. We have to go ahead and do a valuation, just like the way we did for the real estate in the previous example. And in general, stocks are valued differently. So the common methods which are used for valuation are price to earning ratio, price to book ratio, DCF, EV multiples, etc. So what you have to do is take the price of the stock and divide it by the earning per share, which will give you price to earning ratio, which is a very simple ratio to calculate. The second ratio is price to book ratio, which is take the market cap of the company and divide it by the net worth of the company. Or in simple term, take the price of the company divided by the book value per share, or DCF, which is a very complex method, which is discounting the future cash flows, which will give you the intrinsic value of the company. This method is absolutely useful, and this is in generally used by value investors. EV multiples is also used in case when there are a lot of capacities put up by the company. So, for an example, companies like metals, companies in cement sector, companies in power sector, they are valued based on EV multiples. Even a lot of times, EV multiples are used when companies are bought by the other companies. So, in case of mergers and acquisitions, EV multiples are also used. Now, next topic that we want to touch is how major events impact your investment. Now, this is very important because market in works in tandem with a lot of global macroeconomic event, global geopoliticals. So it is very common to see that if North Korea fires another missile, then stock prices will go down. Or if interest rates are cut by the RBI, Indian markets will go up. So it is very common to see that such phenomena continue to remain in the market. So let's see how in general a few examples where markets have reacted to the lot of macroeconomic data. The first example that we are saying is how Sensex has performed over a period of 91 to 2006, which has given a superior around 12, 13 to 14% return during this period, and that I am correlating with India's GDP growth. Now, post 19, what we know is during the 1991-92 period, Indian economy was liberalized by the then government, which was PV Narasimha Rao government, and with that we opened doors for the foreign investment, foreign products. So that helped our GDP to grow by around 5 to 6% during the first period, and in general around 7 to 8% in the long run, especially in the last decade. Now, with the faster GDP growth, companies were also able to grow faster, and that has clearly reflected in our journey of Sensex, which has delivered superior returns during this period. Now, if you go back to the first one of the first slides, which I told you about how fixed income and other asset classes and equities have performed, now this chart clearly shows that how Sensex has delivered these superior returns. Now you can see that there have been a few periods where markets have not done well. For an example, in 2008, during the financial crisis, market had tanked around 60%. Despite that, markets have delivered these phenomenal returns. So in the long run, market tend to be very positive for the investors and in general generate wealth. Next slide that we are looking at is how inflation has led to the Sensex appreciation. What we see is in 2014, inflation started to come down. Along with that, interest rate also started to come down, and this has helped Sensex to uh, gain in value, because in general, when interest rates go down, fixed income, as in the fixed deposit, become less attractive, so people tend to invest in stock markets, and that you can see all the time. As interest rates go up, a lot of flow in equity go towards fixed income. On when interest rate go down, that flow comes back in equity. So this is in general a common phenomenon that happens worldwide, and this happens because of those people who are risk averse. They will any small increase in the interest rate will push them towards fixed income, and vice versa. Next slide that we are looking at is how India's per capita GDP has grown over the years, and that is clearly beneficial for the consumption story of India, because a lot of companies in India are dependent on how people grow their domestic income. So before liberalization, India's per capita GDP was doubled, and it took around 30 to 35 years to double this per capita GDP. But after liberalization, post 1991-92, it took only 14 years to double the per capita GDP. And once per capita GDP increased, the consumption story of India started, which is reflected in India's Sensex and Nifty indices. Next slide that I'm showing is how government policies and equities impact the stock market. Now, this is a very fairly latest example. I'm just showing a chart since demonetization. So what we see here is, as soon as demonetization was announced in November 2016, Indian markets collapsed by 5%, because there was concern that how it will be in generally managed, how will people be able to uh, go ahead and buy stuff, how companies will be able to do business. So markets collapsed, and then once there was clarity that government is bringing new notes and in general it will not be as bad as expected, there was 16% gain in the stock indices. Now then, second I'm highlighting the GST period. During that period, there was, in general, a lot of pessimism that how GST will impact businesses, whether there will be proper tax collection, and how the slabs are going to impact, will it be impacting the inflation, etc. So during that period, and there was no clarity how GST will be beneficial or it will be implemented or will it be successful. The market was sideways. But once there was clarity, then there was again 10% gain in the markets after GST, and that happened in within a period of 5 months. So within a year, we have seen that market gyrating between negative and positive returns because of two events. Now think about it that in general when and the government policies are not meant for the short term period. Now you think about it that when there is a big policy comes which leads to some pessimism in the market, but in general it is going to be beneficial for India's growth story. So one should go ahead and buy good quality stocks when there is some correction. So all such kind of correction should be used to buy shares. And if there is a very high optimism and then there you don't see that how markets will go ahead. So any positive note due to very good macroeconomic data, one should go ahead and sell the stock if there is no clear trajectory of the market. Now here I'm showing how economic cycles work in general. So what we see here is that the yellow chart is showing that the markets or in general economy going in recession, and after that there is recovery. So why we need to see is this, because in general what happens that when markets or economy is at peak, in general you will see that inflation levels are at high, and because of the high inflation the government will have fiscal policy, so they will increase tax rates, or RBI will go ahead and increase the interest rate. So with that, the markets will start, because as I mentioned earlier, as soon as interest rate increases, fixed income become attractive. So people will move their money from fixed income to equities to fixed income. So with that, a lot of the valuations will start dropping, and because of high interest rate the businesses will also start impacting because their interest cost will increase, and so people will buy less cars, people will buy less consumer durables, businesses will invest less in manufacturing because sales are declining. So because of that, once they start declining their production and their sales starts declining, they will also reduce their workforce. So this has a very cascading impact, because with the reduced workforce there will be further less demand, and this goes on for years, and this leads to full scale recession in an economy. Now because of recession, now government will step up, cut the tax rate to boost consumption and investments, and central bank will also go ahead and cut the interest rate. Now this will slowly bring the economy back on growth track. So companies will start hiring more people, they will start producing more because demand in generally is strengthening, and then recovery will start, and there will be a point of time in future when economy will be back on track, back to a good GDP growth rate, etc. And again, this cycle will play out where people become very optimistic, and they will again start buying a lot of things. There will be interest rate hike, then again a recession. Economy will move into recession. So this is the long-term cycle that plays in any economy, and in general this helps people uh, to buy shares, especially specifically investors, that when markets are down people will buy more shares because that offers a lot of companies at very steep discount, and then in recovery phase investors will sell their shares and become wealthier. Now, having talked about the basics of stock markets, we'll go ahead and find out what are the in general how people in big investors tend to generate their wealth, how they invest. So first thing that they do is they don't select a stock; they actually look at the business. So what this means is that if you think of a stock as a only stock or just a script, then probably it's a not a good way to look at the investment, because when you're buying a share, you are buying an underlying business. So you have to analyze the business. So you are buying a share of Reliance. You have to see how that business is run and what is the future outlook of the business. You so in simple words, would you be better off with a business that has a good growth prospectus, or a business with have no opportunity? So would you be happy with a business that has huge debt? There is basically there is no profit, but because it is available at a very low price or less valuation, would you buy it? Or you will buy a business which is at a discount but has a very good prospectus, very good management, balance sheet is strong, etc. So you have to look at the business and not just the stock price. The next is buy good business when prices are down. Now, this is in tandem with the earlier slide which I talked about economic cycle. So when there is recession or in general economic slowdown, you get a lot of stocks, good quality stocks available at huge discount. So if you remember, Maruti shares of Maruti Suzuki were available at huge discount. Uh, excuse me, a couple of years ago. Today that share is around 10,000 rupees. Within 2 years, that stock has appreciated by around 100%. Now that works out to be a CAGR of 50% every year. Now you want to generate wealth in your investment or through especially through the equity markets. The best way is to find out the quality stocks in the market. Whenever there is some fall in the market, just go ahead and buy those scripts and hold tight for some years, and you will make money in those scripts. Next is buy quality stocks and hold for long. Now, if you buy a company today, you cannot say that this company has to deliver returns in 6 months or 3 months. You have to wait. You have to sit tight on the investment for a few years, and in the long run, that will give you huge returns. Now, again, I want to tell you about the one of the charts of FD versus equity investment, where equities have outperformed the fixed income by wide margin. Now that has been because anyone who had bought stocks in 1991 would have generated huge money because the method of compounding has worked there. And that basically means the company which you are buying, that will help you. First thing, that company will grow because in general a good company will generate good profit in a very good economy. Second is, with the profit growth you also get re-rating of the valuation. So, and third is the long term. In the long term you get, along with the price appreciation and growth, you get compounding effect. So in long run, let's say 5 to 10 years, you will be better off with investment generating far more returns than fixed income or real estate. The fourth is only by businesses that you understand. Now, this is very important thing because there is not a single person who understands all businesses. It is very difficult to analyze every business by a single person. You could be knowing a few businesses, but not all. Now, does anyone understands how electrical vehicles are going to impact Indian automobile industry? No, because because companies are still thinking how to invest. So even companies are skeptical that how they are going to do business of electrical vehicles in India. Now think about pharmaceuticals. Are we going to understand every single drug that you want to invest? So if you want to buy shares of Lupin or Sun Pharma, do you understand every other drug? Do you understand the legal standpoints of every other drug or every other global regulator? No. So it is very important to understand the business in which you want to invest. If you don't understand the business, then probably you are missing a lot of things. So what you will be missing is when what kind of triggers, upside triggers and downside triggers that company has. And if you don't know the triggers, probably either you will sell prematurely before profit, or you will book loss because you are not sure, basically because you don't know how the company is operating. So first and most important thing is to understand the business, or else do not invest. Then this is a classic rule of where how portfolios are built. Now here, do not put all eggs in the same basket. Now why it is important in general is, people tend to invest in single asset class. So people generally will invest in general Indians have been investing in fixed income. Now what happens is, fixed income is a relatively safe but has no track record of huge wealth generation. But if some aggressive investors will go ahead and buy only shares, and that shares of only one or two companies. Now, what happens is, in case of defensive investment like fixed income, people will not get huge wealth appreciation. But people with aggressive approach, the problem is that when their shares fall, all of or most of their net worth will be eroded because of this. Now, how to protect this is by making a portfolio where you have different types of stock, defensive, aggressive, or balanced, and also fixed income in there. So that you make sure that you have a component of fixed income that will give you regular 5-6% returns. You have aggressive stocks which will give you far better returns than even other equities, and then you have stable equities that will perform over the years. So that portfolio will excuse me, that portfolio will reduce your risk and also give you a huge capital appreciation over the years. So that is a classic rule how you diversify your different asset classes, your investment. So here you can either go in only equities and diversify in different sectors, or you can make a big portfolio where you have fixed income there, gold, and you have a diversified equities portfolio. The next is be fearful when others are greedy and be greedy when others are fearful. Now, this you have to correlate with the economic cycle that I mentioned, where there is recession and boom. Now, during, as I mentioned, in the recession, because asset prices are available at huge discount, people will go ahead, specifically the big investors, big mutual funds, they will go ahead and buy quality shares, and they will hold it for until the time when there is recovery, or they are sure they feel that now is the time that we should go ahead and sell the shares because economy has achieved a peak of its growth. So then these people, these all investors, mutual funds, they will go ahead and sell the shares because, and then they get huge appreciation. Similarly, now what happens in general is when there is huge economic optimism, retail investors generally come at the end stage when there is a lot of speculation, and they tend to enter at wrong time, and they tend to lose a lot of money because they have bought assets at a very high price, and after that there is in general after speculation comes is a crash. In general, after the crash, they lose their confidence because whatever they had bought, that has depreciated in value, so that reduces their confidence. So it's best that you follow all these mantras given by big investors, where you invest when others are fearful, which means you are actually buying the prices at very low price compared to their intrinsic value, what they're worth. So basically, you are buying shares of Maruti instead of 10,000 to rupees 8,000 or 7,000. So that in generally will give you 30% return whenever stock comes back to its normal level. So that is one big mantra that you have to follow. Next, we talk about bull market and bear market, and these are two terms which are widely used when there is either optimism or pessimism. The bull market is when there is, in general, huge optimism in the market. All asset prices are in general rising, or shares are rising, and because shares are rising, it encourages more buying. So you see shares going up, then you believe that it will go up again, so you will buy the shares because there is huge optimism, investor confidence is very high. But what happens in bull market is that during the end phase of the bull market, there is a huge speculation. So in speculation, as I mentioned earlier, the stock prices enters a category when everyone is talking of share market, how to make money, and then because of widespread optimism, people will go and buy shares of any company, which will because of the speculation, the valuations of these shares will go up like anything. And once they realize that what they have bought is at very high price, very high valuation, then they will start selling because they believe that now it will not go up, and because of their selling pressure, the stock prices will collapse. Now bear market is exactly opposite of this. What happens in bear market is share prices are in generally falling because of several concerns, which could be poor economic growth, high inflation, high interest rate, wars, geopolitical pressure, or global economy not doing well, something like that. So because share prices are falling, it also encourages selling pressure. So even investors start selling that. So in generally, when market falls by around 20% in 2 months, then it is considered as a bear market. So 20% decline in the index is a huge decline, because mid caps which have very high beta, they will correct by more than 45%. So that is a very bad case. People will start selling, but then big investor will come here and buy the stocks, which I mentioned you earlier. Now I am showing you a chart over here where I'm telling you when there was a bear market or bull market. This is since 2001, and what we see here is that since 2003 to 2007, there was a very big bull market of in the recent India's history. What we see is that the stock prices started from 5,000, nearly tripled within a period of 4 years. Now that is a very big bull market, and a lot of people made a lot of money. But what came afterward is global financial crisis in 2007, that was led by the housing crisis in USA. So what we see is that at the top of around 20 21,000 level in 2008, the market collapsed by 60%, which led to huge depreciation in the asset prices and recession. After that, market was corrected, but the next bull market came in 2000, during start of 2013, and that was because the crude oil was cheaper. There was optimism of economic growth because India's elections were coming, and Narendra Modi by was elected as a PM candidate. So that led to huge optimism. There was also a low interest rate during that period because inflation had started to come off. So RBI went ahead and cut the rates. So that also helped to increase, to re-rate the market, and then we saw a huge bull market. Then again, since the beginning of 2016 or 15, there was decline in the asset prices, which was led by China's the concerns over Chinese economy, and it was expected the Chinese economy will grow below its potential. And China is a huge economy and huge exporter, so which means that probably that economic concern will be spread to other economies. So that led to around 20% fall in the index. And next is the current market, which is regarded as a bull market. What we see is after demonetization, market has shown huge appreciation, and that is because in general Indians macroeconomy uh, are good. Then we have low interest rate right now, and political stability is also one of the best in last several years. So, and we are also looking at several reforms like GST demonetization and FDI reforms, etc. So that is also helping Indian economy to grow. So that is helping index to grow since end of demonetization. So this is a bull market that we are currently in. Now let's look at a few terminologies which are important in the market. Now I'm not covering all the terminologies, but in general, I'm covering a few that are in generally talked in on the media or television, or even if you are talking to some broker. So this will help you to understand what they're talking about. So a primary market is a market where a new issues are sold for the first time. So in general, when you see an IPO, it is a first primary market, because that is where a company for the first time will come and sell their shares. Next term is secondary market. Secondary market is after IPO, the subsequent trading of the shares happens in the second market. So when you go and put your order to any sub broker or broker, what you get, what you are dealing with is a secondary market. A dividend is a sum of money that is paid by the company to the shareholders. So if you buy shares of, let's say, Coal India, then Coal India is a regular dividend paying company. So at the end of the financial year or in between as well, company will announce regular dividend, and what you get is the dividend, which is not the share price returns from share price, but it is because company is sharing net profit with its investors every year. So that is a dividend that you get. Now valuation, as I discussed, is a sophisticated method of calculating the theoretical value of companies. So as I told you earlier, it is there are various methods. One is price to earning, price to book value, EV by EBITDA, EV by sales, price to sales, and also DCF valuation. So what happens is in that process you look at similar companies of similar market cap of same business trading at what different valuations and what are different ranges, and based on their ranges you value a stock, that this stock should be valued at this price to earning, and you find out what should be the stock price. And this helps you in finding undervalued stock in the market, which over the years become a good investment if they are undervalued. Next is market cap. A market cap is nothing but share price multiplied by number of outstanding shares. So you are holding, let's say, one share of Maruti Suzuki at 9,500 rupees. Now that is a price you are paying for one share. But collectively there would be crores of shares. So that crores of shares into number of share, what is the price of the share at the moment? So when you multiply that, what you get is collected total collective value of all shareholders holding in the company. So that is called as market cap. Next is the technical analysis, which is a method to identify stocks using price, volume, and chart pattern. Now, this is in generally what you see a lot of calls being given based on technical on television or newspapers. So these that is in general technical analysis. Fundamental analysis is another method of stock analysis. Now this uses a robust approach of using financial statements, business, economy, industry, and different other sophisticated method of valuation which I mentioned earlier. So that is a part of fundamental analysis. Portfolio. Now portfolio, if you remember, I told you about not putting all the eggs in the same basket. So what it makes it is a portfolio, which is a range of investment held by a person or organization. It has different asset classes such as FDs, equity, real estate, or it can have only equity portfolio including stocks of different market caps, different industries, etc. Finally, I'm looking at the Sensex and Nifty, which is a collection of the selected stocks in the country. Now, why Sensex and Nifty is done is because you have to understand overall how economy is doing, how the markets are doing, and Sensex and Nifty helps you understanding the sentiment in the market in general, how economy is doing, and that index also becomes part of government's understanding of financial markets, investors understanding of the financial markets, and the stocks that are selected are of different sectors. They represent large portion of Indian economy, and the markets cap are huge, and they represent different industries. So as the share prices of underlying companies appreciate or depreciate, index also fluctuates accordingly. In conclusion, what we have understood so far is stock markets are not volatile, but in the long term they tend to outperform all the investment grade asset classes. Stock markets represent the economy, hence bear and bull markets fairly indicate the state of national economy. High price stock don't necessarily be expensive stocks and vice versa. Value is determined by the underlying business, and understanding of the business is paramount. Disciplined investment in the equity markets is a way to prosperity. And finally, if not direct, one can invest in the markets through mutual fund. So you can make a portfolio of mutual funds as well. So this was the end of the presentation. I wish to thank you at this point of time. Uh, we are now going to begin answering the questions submitted during the today's presentation. As a reminder, you can still submit your questions through questions pane in the attendee control panel. So I will wait for a few minutes so that the Q&A is assembled, and then we'll take the questions. Thank you.